Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Organon stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Organon is a women's-focused pharmaceutical company. It specializes in reproductive medicine, contraception, and hormone replacement therapy. It has 11 products in the women's health category, 5 in biosimilars, and 49 in established brands. A biosimilar is made from a biologic or natural source, where generic medicine is made from chemicals. Nexplanon is leading the way with $184 million of revenue in Q2 2021. Nexplanon's target annual sales is $1 billion. It is a single implant, long-acting, reversible hormonal contraceptive. Simply put, it is a birth control implant that goes in the arm. It is just as effective as the pill, but without the daily hassle. Organon's predecessor company was founded in 1923. Its first product was insulin. In the 30s, it manufactured estrogens. Merck announced that Organon will be the name of the spin-off of its women's health segment. If you owned 10 shares of Merck on or before May 17th, then you would receive 1 share of ticker OGN after it was spun off from Merck on 6/2. For example, if you owned 100 shares of Merck, say in January of this year, then you still own 100 shares of Merck today, but you also own 10 shares of Organon. If you have 9 or less shares of Merck, then you would just receive the cash from the spin-off company. A parent company will spin off part of its business if it expects that it will be lucrative to do so. The spin-off will have a separate management structure and a new name, but it will retain the same assets, intellectual property, and human resources. The parent company will continue to provide financial and technological support in most cases. Now that Organon is a separate entity, it can better focus on its specific drugs. This company controls 20% of the fertility market, but since Organon is not part of a larger organization anymore, it can focus more on women's health and get a bigger piece of the pie. China is a big opportunity since fertility rates are high in that country, plus there are so many people there. In 2007, whistleblower lawsuits were filed against Organon in federal courts in Massachusetts and Texas. Organon was accused of selling its antidepressant medication Remeron at a discount to nursing home pharmacies, yet filing claims to Medicare for reimbursement at the full undiscounted price. Organon agreed to settle the case for $31 million in October 2014. This month, Warren Buffett bought 1.55 million shares of this company. That alone should be a good reason to buy this stock. The company is headquartered in Jersey City, New Jersey, and was founded in 2020. It started trading in 2021 and can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, and Euro TLX. Let's get started with the model. This is a mid-cap company, 8.7 billion market cap. They're trading at $34 a share, and they have 254 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they do have a lot of free cash flow. It does go down from 3.6 billion to 2.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that goes from 2.2 billion down to 1.7 billion. Revenue is the sales for the company, and that decreases from 9.8 billion to 7.9 billion. A reason they spun off this company is because it was struggling and they thought it would operate better as a single entity. Because when you operate within a larger organization, it's sometimes harder to grow because there's a lot of political things going on. But when you're a smaller organization, it's going to be easier for them to focus on their end goal, which is women's health. This is the company's income statement. The top line is the revenue, the sales. This is their revenue in Q2 2021. Also their revenue in Q2 2020. They do have the highest revenue in Europe and Canada. Second is the United States. Their revenue increases in every location except Asia Pacific and Japan. The company did mention they want to grow their revenue in the United States and China. They think there's a lot of opportunity there. Below revenue is the cost of revenue. Manufacturing costs to make their products are a big cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that was lowest in the trailing 12 months at 4.4 billion. Then below that is operating expenses. Selling, general, and administrative expenses are a higher operating expense for this company. That's usually payroll for support functions, rent for the corporate office, also advertising and promotional materials. and they spend a good amount in research and development. A company like this always needs to spend a lot of money in research and development because they're always looking to develop new drugs. So they do have a lot of operating income each year. It was lowest in the trailing 12 months at $2.2 billion. And the bottom line of the income statement is their net income, which is pretty high each year, lowest in the trailing 12 months at $1.7 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a ton of operating cash flow, $3.7 billion down to $2.8 billion. And they have a good amount of capex each year, because they always need to buy expensive machinery and equipment to develop and manufacture the drugs. Operating cash flow minus capex gives you your free cash flow. So even after operating their business and investing back into it, they still have a lot of free cash flow left over. And they just started paying a dividend this month, and it's a pretty good dividend at that. But you can see they added a lot of debt in the trailing 12 months, $10.7 billion. They needed to give $9 billion to Merck due to the spin-off. But even with this debt, they bring in so much free cash flow, they can easily pay the interest payments on their debt and probably knock off $1, maybe even $2 billion of debt each year. This is the equity section of their balance sheet, and they have negative $2 billion of equity. They don't have any additional paid-in capital because they're a spin-off. They didn't actually IPO and raise any capital. So these numbers are as of 6/30/2021. And this entity started in the beginning of June. So there's no operational information on their balance sheet. So that's why their retained earnings are negative. Next year, it'll be positive because they're bringing in lots of profits to this company. They just have negative equity because they took on a lot of debt that they had to give to Merck prior to the spinoff. Let's look at the capital structure. They have negative equity and $9.3 billion of debt. So they're 100% debt. Their weighted average cost of capital is 9.11%. Usually I would give a whack of 7 to 8% for a company like this. But since they're such a new spinoff, I gave them a little higher whack because there's not much operating history by themselves. So it's a little more riskier than if I valued a spinoff company several years after the spinoff. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $28 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $26 billion. We divide that by 254 million shares. And we get a calculated stock price of 104. They're trading at 34, so they're trading at a 67% discount. It's a really strong buy according to the model. The reason their free cash flows are decreasing each year is because my model looks at the prior free cash flows, net income, and revenue, and calculates future free cash flows based off of those numbers. And since their revenue is decreasing the past 4 years, the future free cash flows are also decreasing. I kept it this way because it's a more conservative valuation. The CEO of the company said he expects mid-single digit top-line growth. So that means he's expecting revenue to grow around 5% a year. In my model, I have revenue decreasing. If it increases, then the stock is worth like $200 a share. Simply Wall Street is even higher than me. They're at $134 a share. They're saying the stock is 74% undervalued. 5 analysts priced this stock and the average price target was $39. There's a difference between pricing a stock and valuing a stock. If I was to price a stock, I'd probably put it pretty close to what they're saying. Because the reason the stock isn't trading higher is because I think people feel Merck got rid of their garbage. They spun off a segment that was struggling, had declining revenue. So I think until Organon can prove it could stand on its own and even increase revenue, I think until then, people won't buy it. This is where the stock has been trading since it was spun off, so it's pretty flat. It did decrease right away, but it has come up. And for the past few weeks, it's been pretty flat. They just started paying a dividend this month, 28 cents a share. That's a 3.27% dividend yield. And they can easily afford this. That's only 16% of their net income, 11% of their free cash flow. And their dividend is higher than their industry, which pays a 2.5% dividend. But analysts are forecasting them to decrease their dividend to 2.9%. The stock is up 3% since it started trading. The low is 27, the high is 39, and the stock is trading above its 50-day and 200-day moving average. 2 to 4 million shares are traded each day on this stock. Of the 254 million shares outstanding, 252 million are on float, 69% are held by institutions, and 2% of the shares are shorted. So you can see the stock is up 18% in the past 30 days, but down 4% in the past 90 days. You should probably wait a few weeks to buy a stock when it first comes out because it usually declines right away. But you don't want to wait too long because you might miss all the upside. Analysts are forecasting their earnings to decrease 9% and their revenue to be flat. In the past 5 years, their annual earnings decreased 2%. In the past year, it decreased 38%. If you invested $10,000 into this company when it started trading, you'd be at a little over $10,000 today. The biggest shareholders, Vanguard at 11%, then BlackRock, 6.5%, State Street, MFS, originally Massachusetts Financial Services, but they shortened the name, and then Geode. Let's look at their financial ratios. Look at their PE, 5.0. What an amazing PE ratio. Value investors like to see a PE below 15, and they're 1/3 that. A really low PE could mean an undervalued stock or a value trap. Let me give you an example of a value trap. Say it was the mid-90s and this new technology came out called DVD players. And these things were going to take over the market. VCRs were going to be obsolete. But how could VCRs be obsolete? They're in every single home in America. And if you looked at VCR stocks, the PE was in the single digits because their net income was so high the past few years. They were making billions of dollars. But their market cap was so low because everybody was selling off their VCR stocks. And investors were buying into DVD stocks who had PE ratios in the hundreds. That's an example of a value trap. A dead company like a VCR company with amazing revenue in the past that has a really low market cap because nobody wants the stock. But in this case, the company is making products that are used, that are needed, and they still generate lots of cash flow. So in this case, I feel it's an undervalued company, not a value trap. They also have an amazing price to sales ratio of 1.1. We can't look at the price to book because they have negative equity because they took on all that debt due to the spin-off. And they have $5 billion of intangible assets on their balance sheet. They have a really high return on invested capital at 26%, extremely profitable company. And I gave them a higher WACC and they still easily cover their WACC. You generally want to invest in a company with a higher ROIC than its WACC. They have a good current ratio and quick ratio. They have $700 million of cash on their balance sheet, $1.5 billion of receivables, and $900 million of inventory. So the company is really well capitalized. They had $2.5 billion of free cash flow, over $900 million of working capital, and a little less than $300 million of dividend payments. So they have over $3 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 14 other companies in the same industry as Organon. And if Organon has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So here's Organon and here's Merck. So you can see Organon has the best price to earnings and price to sales ratio of all the companies. Merck is pretty high in PE, but they do have a good price to sales and price to book. Both companies have a good current ratio. Merck is average in ROE. Merck is about average in debt. Organon's high in debt, since they have negative equity. And Merck is a massive company, 193 billion market cap. Organon is really small at 8.7 billion, but that should be going up. They both pay a higher dividend than the industry average. So to summarize, I have them trading at a 67% discount. I think this is a great long-term hold, but it may take a year or two for investors to realize the value of this company. I think they just see declining revenue and think the company is not good. Even if their revenue did decline 5% a year, the company would still be worth a lot of money because it'd be generating billions of cash flow each year. Sure, maybe after about 100 years, it would be worth almost nothing, but for the next 20 or 30 years, it's generating a lot more cash flow than 99% of the companies that are public. And most people don't have an investment horizon more than 20 or 30 years. But most people aren't looking into the detail that we're looking into. They're just looking at the high level information and also the fact that Merck spun off the company. So they may feel this company is just something Merck wanted to get rid of. But when it does have its first quarter of really strong numbers, the stock will shoot up. But until then, it may lag and actually may come down a bit more. I rank their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.